Folks, I've been on YouTube since 2016. I've produced on this channel alone over 2,000 videos. I do not believe I've ever created a more valuable video than the one you're about to watch in front of you right now. I don't know if I'll ever create another more valuable video than this one you're about to watch. Let's be very clear about this. And I want everybody to show Jarch a lot of love in that comment section, okay? And I don't even care if you're one of those people like, I don't ever comment on YouTube videos. Comment for this one, okay? And show this man some love, because the question he asked was such an amazing question that I felt like I was going to just do this as a private group video, and then I was like, I need to do this for everybody on YouTube, because this is one of the most important subjects that is not discussed enough, and this will cost you the most money in the stock market, either for better or worse, whether you're deciding to buy the dip in a stock or not buy the dip in a stock, or cut losses in a stock. There's no more valuable subject than the one we're getting into in this video here today. And I'm going to go through all my different points on how I look at this, how I observe this, everything like that. It's as valuable as I'll ever do forever on this channel. I hope you guys enjoy this. Smash the thumbs up if you enjoy a video like this. And once again, make sure you show some love to Jarch. Beat the bots on this one, okay? Because you already know those bots are coming, man. They about the AMZ coins or whatever the crap they always are posting about. So beat the bots on this one. Show Jarch a lot of love, because this is amazing, okay? So is in the private Discord chat. And by the way, if for any members that are in the private Discord chat and you ever post a good question or showing love or whatever and I don't get back to you, always feel free to send me a DM. Like, there's a lot of chats, there's a lot of stuff to go through in there, and I don't always get to see everything. I'm lucky and fortunate to have seen this one, because this is great, okay? It says, all right, financial education, Jeremy, I got some stuff to challenge you on and see if you have been considering these various aspects of individual stock investing. So first thing is, I want to preface that this comes with a very open-minded discussion point of view, so please don't take it as disagreeing or being argumentative, just my best observations. So something I've noticed over the last year is that it seems that many retail investors, and in some cases you and myself, have used the terminology of long-term investing to take it as an easy way out of not cut a position to reduce exposure when fundamentals shift away from our forward-looking expectations. I feel like this is a massive flaw when it comes to individual investing, and at some point we have to realize that the boat is starting to turn so we can jump ship before we get wiped out, as in not go down with the Titanic, right? Granted, it is much harder said than done, but I think there is a benefit to emphasizing this type of maneuver when an investment thesis has deviated and the new risks introduced into the thesis should be accounted for as we reevaluate the investment. In general, I do believe in the long-term investing mindset, but I also believe it is critical to manage risk, whether that means cutting a loser or maybe even trimming or cutting a winner, if it has run into an extreme evaluation territory. So I'm curious if you reflect on this aspect of individual stock investing and when to cut a position. I feel like the buy the dip, DCA mentality from index investing somehow got caught up into individual stock investing, and I believe this is a very dangerous mindset to have when investing in individual stocks. Indexes are able to automate cutting losses in companies out of them and essentially manage the self and buy side to do automatically. I feel like the decision-making process of cutting a position for a win or a loss is very important and not talked about nearly enough, okay? Absolutely amazing. I mean, it doesn't get better than that. It does not get better than that. And I got to tell you, after I saw that, and I never do this, it has to be something profound to make me do this. I just paced back and forth in the house for 20 minutes, just thinking about it. Like a pinball, just thinking about this, okay? And how I wanted to even go about, talking about this. And there's no more important subject than what we're about to talk about here. When to say, you know what? I need to either stop buying the stock or I need to just jump the boat, right? And so let's go ahead and discuss this. I want to go through my 5 different kind of factors here, and we'll talk about that. And then I also want to attack this point, because I think it's very important, about the buy the dip mentality. And does it work for individual stock picking, right? Or is it only for index funds? Because I think that's very important as well. And I'll share that as well, okay? So when to stop buying, or just say, whether it's stop buying a stock or selling a stock. We're just going to group those kind of together, right? The first of these 5 is if the management makes a major F up, okay? If they make such an an enormous error. I think that's a great moment to say, I need to stop buying the stock, or I even need to potentially consider selling the stock, right? And I'll give you two examples. One's an example that, embarrassingly enough, I did not do, and another's example of another company, okay? First one is, on this date, what happened here, and I hate to even bring up this stock or talk about this dang stock because I'm so sick of talking about it now at this point in time, is when they had to reschedule their earnings November 10th, 2021, at that moment, I should have stopped buying that stock right then. That was such an embarrassingly enormous error and such a huge management mistake. And I can tell you the Jeremy of a year before that and the Jeremy of today would have went back and slapped that Jeremy to continue to buy that stock. Even in that just showed how much of a complete junky phase I was in at that particular moment, right? And it'll be forever a moment I look back on in my life. And it's just one of those cringe moments. And there's a few moments of my adult life I look back and I'm just like, and that's one of those moments where it's through the whole blueprint out and oh yeah, they're postponing their conference call and their earnings on the same day that their earnings are supposed to be out. That's definitely a moment like that, right? If, look at a company like Tyson Foods. Tyson Foods, it was announced last month that their CFO was so drunk and intoxicated that he broke into somebody's home and, and supposedly the door was unlocked and he went in the home or whatever and just stripped down and went to sleep in some lady's bed. She got home and she called the cops. And that's one of those things that it's this is a chief financial officer of this company, just got so wasted he's sleeping in somebody else's home. That's ridiculous, right? And so when it's something so obvious like that, it's a great moment in time to say, you know what? I'm going to stop buying the stock. Let me wait a few quarters. Let's see what happens here. Let's see what transpires, and then I'll consider whether I'm going to either sell the stock or whether I'll buy more or what I'm going to do. But that's a great moment in time. If they make such a big mistake that it's are you kidding me? This happened? When it's one of those, that's a great moment, okay? So that's the first one up here, okay? Second up here is if a company is doing far worse than their competition, this is a great moment to stop buying your stock you're buying or potentially even selling it, okay? So I'll give you a good example, right? Let's say you own a grocery store chain, right? And this is just an example I made up. So this is your stock. You own grocery store ABC, right? Grocery store ABC, their revenue's up 2% in the quarter. Their gross margin's down 1%. Their net income's down 3%, right? And then you go ahead and you look at their competition's earnings. Their competition earnings come out, right? Grocery store XYZ. The revenue's up 3%. The gross margin's up 2%. Their net income's up 4%. They're getting wrecked by the competition, right? And so that's a great moment to say, you know what? My company is not what I thought my company was. And they're clearly getting beat by the competition, which means their business model, their strategy, and likely their management team is not up to standards. And I either need to consider to stop buying the stock, consider selling it, or maybe even swapping out shares for the obviously the much more quality company there that's eating my company's lunch. No pun intended, being that it's a food store, okay? That's the second way. The third reason to stop buying a stock or even consider selling a stock is based upon valuation risk, okay? Now, this is a very hard one for folks to sometimes wrap their heads around, right? Because all stocks, and I don't care what we're talking about, all stocks are valued differently. And they're valued differently for many various reasons, right? And sometimes it could be on growth rates. Sometimes it's based upon the industry. Sometimes it's the people look at the business model and it's is it a recurring revenue stream business model where they keep collecting revenue all the time? Is it a one-off product, right? Is it B2B? Is it, business selling to consumers? Is it B2C? There's so many various factors in that, right? That can make valuations differently. But at the end of the day, if you own a stock that is at such an insane kind of valuation, that's a moment you can take and you can say, maybe I need to sell this, or if it does dip, I'm not going to buy it anytime soon, okay? And there's a very famous stock. There's a very famous stock of mine that I had to fight with a lot of people about this stock over the past couple of years, okay? And specifically over the past 18 months. And now it has gotten to a moment where I'm almost ready to start buying that stock again. But I had to fight with a lot of people who did not agree with me on this one. And unfortunately, it is good old Tesla Maesla. So Tesla Maesla got to extremely high valuation levels where this company had begun to price in years of growth, right? Years of growth. So as the stock dipped I wasn't interested in buying it because it was priced in a very silly manner. And, if you look at this stock, right, the stock at around this time last year, roughly, it was valued at 343 trailing PE and 121 forward PE, which means it was pricing in several years of growth in front of it. Several years, not 1 year, several years, okay? Now, you look at Tesla today, it is valued much differently. It is valued at a 60 trailing PE and a forward PE that's in the 30s now at this point in time, okay? So the valuation is like night and day difference between where the stock was at a year ago versus where the stock is at today, okay? And what I looked at when I was kind of viewing this company at that time, right, is there was just, there was like no upside potential essentially at that point in time. There's only downside risk. Because at the end of the day, I looked at it and I'm like, they got this massive backlog. The economy's been going so good. We could have a lot of risk over the next couple of years in terms of the economy, which can obviously hurt a business model that sells high-end cars, right? Relatively high-end cars, not super high-end, right? But still upper price points. And, it's just so many things had gone right for that company for obviously quite some time. And when it got to those valuations, it just got like, where's the upside? Where's the upside at that point in time, right? And you need some just downtime for that stock to catch its breath, right? And so the way I look at that stock now, it's at a very different place. They've grown a lot over the past year, revenues, net income, everything, right? And the company's valued substantially less than where it was valued, which makes the value proposition much more compelling. So sometimes it's a hard decision, even in a company you love. Like I love Tesla just as much as anybody, right? But at the end of the day, I looked at the valuation. I was like, oh man, this is not so attractive right now at all, okay? But now it's a very different story. So if there's valuation risk, that's a moment where if you see a stock dipping, you don't have to buy it. Or you could even potentially say, I'm going to go ahead and cash up here and I'm going to sell some of these shares because it's just priced in way too much, okay? Fourth up here is if there's what I call random huge serious risk, okay? Now this can be this can be various things, okay? And it's not always the same thing. It's not like some of these, it's pretty obvious, right? It's just random. And I'll give you a couple examples so you know what I'm kind of talking about in regards to this, okay? The first example is a stock I used to own several years ago that I had to sell out of, which was a company named Alibaba, okay? Baba. First off, I love Baba's management team. I love Baba's opportunity. I love Baba's company, the numbers, the valuation, everything was great. But I had to sell out of that stock a couple years ago because what I saw in Baba was I saw a company that was caught up in something much more serious than anything out there. It was an ADR situation, meaning, essentially it's not the same ownership rights as if you buy an American company. As simple as that. You're kind of buying the hope that you own Alibaba shares, which is not the most comfortable feeling as a shareholder. So I viewed it from that lens. I also saw the way the U.S. government was starting to attack Chinese corporations. I saw the changes that were going on in China. So it seemed like things were destined to be in a very bad place when it came to investing in anything Chinese related, right? From the US side, which put a substantial risk on that stock of potentially even down the road being delisted, right? Which is the ultimate kind of fail scenario in this. So this was such a serious monumental risk that didn't matter the management team, it didn't matter the company, it didn't matter the numbers. If you're talking about the potential delisting of a company, right? And it's an actual serious threat, which it is still, but it especially was over the past few years. That's a moment in time where you can't say, as much as I love everything about that, I can't own that. I can't own that, right? And that's been my stance on Chinese stocks over the last several years. And obviously it's been the correct stance, as we've seen, right? Because it's just far too serious of a risk, right? Carnival Cruise Line, a stock that I had to cut, right? And unlike Baba, where I was able to take some nice P's in that one, right? Some nice profits. Carnival Cruise Line was not that scenario. I had to take losses in that one. Very hard losses to take because it should have never happened. But a once in a 100-year health event happened that ended up essentially kind of, I don't want to say ending their business, but putting them almost in ending business territory, right? And I had to cut out of that one because at the end of the day, gosh, if you're talking about their cruise lines are shut down for years, which is what they were obviously talking about at that time, and it was a very serious threat, right? You're talking about the company was either going to go bankrupt or they have to take on so much debt that they might end up going bankrupt just a few years from now, right? And so I had to end up cutting out of that stock kind of somewhere in here, right? And after the stock actually went up. And so it looked like maybe I made the wrong decision because the stock was going up initially after I had sold out. But ultimately, it was the right decision. The stock's lower than where I sold out at. Much lower today, right? Years later than when I sold out in 2020. So at the end of the day, if there's such a serious, monumental risk that it's just something so random, you have to cut. You have to cut or at least stop buying. But usually it makes sense to cut if there's something that serious of a threat, okay? Next one up here is if there's a serious problem with the business model, okay? And then we'll go through some various stocks, and we're going to go through some scenarios where it's not the proper decision to stop buying stocks or start selling stocks, okay? And we'll run through kind of some portfolio strategy and those things like that in just a moment, okay? But if there's serious problems with the business model, stop buying the dip and even consider selling that stock, okay? I'll give you some examples. First one's IBM, okay? IBM hasn't done anything in a decade, literally in a decade. So you could have been buying IBM shares over the past decade and buying the dip and buying the dip and buying the dip for a decade, okay? And you've got nothing to show for it in that stock. But the thing is, it shouldn't come as a surprise that you've got nothing for that because there's serious problems with IBM's business model. And this shows up in the numbers, okay? I mean, if you look at this company, 2011, they do $106 billion. The next year, they do $102 billion. Right off the bat, you know at that moment, I need to either stop buying this one or probably start cutting because they're shrinking revenue into a growing economy. Well, every other company pretty much out there was growing revenues very nice in 2011 to 2012 and to 2013, 2014. This company was shrinking. And then you got another shrink the next year. So at the end of the day, you should have been able to view this and look at a company like IBM and be like, I need to jump ship on this baby. It's dead money, and it's probably going down money. Or I need to just hold my shares and stop buying the dip. One of those two scenarios has to play out because clearly there's a massive deterioration in their business model, right? And obviously, look what's happened with their revenue is like half of what it was back then. Like half, right? So it's clear as day the business model had massive, colossal flaws in it. And you can go through several different companies that, performed terrible over the past 10 years. And it was very clear that there was massive, massive problems in their business model, serious problems in their business model that make you say, I either need to stop buying the dip on the stock or I need to consider selling, right? Because otherwise you're going to get caught up into a scenario like that where the only good thing for IBM is obviously a very profitable company, so they've been able to obviously stay afloat and not go out of business versus obviously an unprofitable company that you run the risk of, they get worse and worse, they're going out of business, right? For IBM, they've been able to stay afloat, but what good is that? Like, you've been in dead money, losing money for 10 years now. 10 years, right? Fatal flaws in their business model. I think Intel's a pretty good example of that, right? And Intel's trying to hopefully pull it together in 2024 in future years after that. But that's kind of been one of those dead money type stocks that they've just been in a bad place for many, many years with a deteriorating business model, okay? Now, what is not a reason to essentially stop buying the dip in your stocks or selling, okay? So not a valid reason to not buy the dip is if the economy is weak right now, okay? Oh, business is weak, so I'm not going to buy the dip. That's not a valid reason. No, okay? At the end of the day, if the economy's in a bad place or whatever, you need to be buying stocks. You need to be out there buying. You can't just lay back and be like, oh, I'm not going to buy right now, wait for it to be. No, you need to buy. And if you are somebody that believes the economy is just going to get worse and worse forever, and you believe companies' earnings are just going to get worse forever, then you're so pessimistic, you shouldn't even be watching this video right now, right? You shouldn't even be in the stock market or anything like that, right? In order to invest, be an investor, let's be very clear, you have to be an optimist. There's no such thing as being a pessimist and being an investor. Those two don't go together, right? You could be pessimistic on the next year, something like that, but to be pessimistic over the next 5 years or 10 years is just, ridiculous, to be quite frank, right? And so you got to understand there's going to be certain time periods where the economy is in a bad place for 1 to 3 years. You have to be able to accept that and go ahead and make the investments in light of a bad scenario, which is a bad economy, which could mean unemployment's high. It could mean inflation's high, right? At the end of the day, you have to be a buyer, and you have to have a blind belief that the future will be better than today is. It has to be a blind belief. You're never going to have confirmation of that. It's a belief, right? If you were not buying stocks in 2009, it was a huge problem, and it was a huge mistake, okay? And although things looked extremely bleak in 2009 and extremely scary in 2009, at the end of the day, the folks that were buying stocks in 2009 and 2010, when the economy was still in a horrible place, were the ones that made the right decisions, right? And you can go back throughout the past 100 plus years in the stock market, right? And certainly if we just want to look at the past 50 years, every single time you should have been a buyer of stocks over the past 50 years, right? And at the end of the day, if you made the decision to not buy, it was always the wrong decision. So that's not a valid choice to say, I'm not going to buy my stocks because the economy's weak right now or inflation's high. At the end of the day, you have to be a buyer. That's the bottom line, okay? Now, to attack the point of, the DCA strategy versus, it's only good for index funds or something like that. I'm 100% of disagreement with that. And I've always been of disagreement for that for 10, 12, 14 years now, essentially, okay? The same strategy does absolutely work in individual stock picking, okay? One of the keys to this is profitable companies that have proven business models. Profitable companies that have proven business models and have obviously exciting things going for the business models over the coming years. Think over the next 5 years, okay? And if you are buying the dip in those sorts of companies and you're buying a basket of them, right? You're buying one or two, you're putting yourself in a huge risk because we know sometimes things aren't going to work out for that company, even if they are a profitable company with a proven business model, right? But if you're buying a basket of those companies, let's say 10 or 15, you can do tremendously well in the stock market and maybe even outperform the stock market and do far better than the index returns, as we've seen time and time again, right? But it's about buying proven business models that have great prospects, okay? So let's say these were your 10 stocks. I just threw up 10 random stocks here, okay? You got AMD, you got Starbucks, you got Amazon, you got Tesla, you got Meta, you got Adobe, you got Intuit, you got RH, you got Nike, you got PayPal. So you got semiconductor company, you got a, let's call it fancy coffee company, I guess we can call it. We'll call it that, fast food, I don't know, whatever you want to call it, okay? You got obviously e-commerce plus a whole lot more, including Amazon Web Services and the cloud and the internet, we might as well call it, right? You got an automaker plus energy. You've got the advertising giant it is. You have Adobe, which is, gosh, there's such a deep business model now at this point in time. Let's call it creative plus cloud. You got Intuit, which let's just call it small business. You got RH, which is a furniture company. You got Nike, which is one of the biggest clothing brand companies in the world. You got PayPal, which is a fintech play, right? So you've got a very well diversified portfolio, and these are your 10 stocks, right? At the end of the day, if you're throwing money in these stocks as they dip, right, the first thing to understand is you got to look for where the biggest dip opportunities are at a particular time, because there's going to be certain moments when one stock dips way more than others, or several stocks dip more than others, right? And so there could be a big difference between if you were throwing in money at Meta when it dipped to $150 versus when it dipped to $80, right? Or $90 or something like that. So you got to look at the extreme dips as, man, I really need to aggressively add in those sorts of scenarios, right? If I had a Netflix on here, right? Netflix fell to under $200. That was definitely a moment to be aggressively adding a stock like Netflix, right? And so as long as you're buying a basket of proven business models that have good long-term prospects and are profitable companies with good balance sheets, at the end of the day, you're going to do very, very well for yourself. And you definitely have the potential of outperforming the stock market over time, right? Because, something like the S&P 500, they don't have the ability to just pick the best stocks. They're picking 500 stocks, right? So you have the ability, if you want it, to look at the S&P 500, study those business models and say, these are the 10 or 15 or 20 best business models for the next 5 or 10 years based upon your study, and actually do far better than the market over time, right? And I think that's very, very important. Now, if you're just obviously throwing money around, you're buying all unprofitable stocks, as we talked about, that's taking a huge risk that's completely unnecessary, right? But if you're buying profitable, proven business models that have been in the financial markets, good balance sheets, good management teams, and you're building out a basket of 10, 15, 20 stocks, you're going to do very well for yourself by buying the dip. You might look bad for a year or two, but at the end of the day, over a 5-10 year span, you're going to look very, very, very well. And I wouldn't be surprised at all if you're doing far better than the market. What causes problems is undiscipline. As you've seen, what are the two main problems I ever had? 2015, 2016, and obviously in that epic kind of, let's call it back half of 2021 into the first, few quarters of 2022, right? Undisciplined, getting away from the blueprint. Let's just buy all unprofitable stocks, right? Or getting caught up into call options, put options, things like that, right? All these different kind of strategies that can be a distraction from just simply buying the greatest companies in the world at heavy discounts, right? You can keep the strategy very simple, but when you start adding complexity that doesn't need to be there, that's when you end up in problems. Adding in margin. Oh, let me try to get a better return by adding margin in, right? Because my stocks are going to do very well. So let me start margining out money. That adds a whole bunch of complexity in there that's probably going to end up creating problems for you. So unfortunately, as investors, many times we get undisciplined. But you could get undisciplined in index funds, right? Because you could still go another route and be like, oh, I'm not going to do index funds now. I'm going to start doing options or whatever, right? So it's just up to you as an investor that you have to stay disciplined, right? And part of that's creating obviously a good support network around you that kind of keeps you in check and does those sorts of things, which is something I'm building out right now, which I'm really excited about for not just this year, but obviously over the next 5, 10, 15, 20 years to have a good support network around me that keeps me on track, because I've gotten off track twice in the past 14 years. They've both been very costly, extremely costly. And by staying on track, you're going to, let's just call it, be in a very good place. Very good place, okay? Hope you guys enjoyed today's video. I hope this was one of the most valuable I've ever put out. I think it's honestly one of the most important subjects that's overlooked in the market. And make sure you show Jarch some love in the comment section, because he's the man that brought up this subject, and I think it's as good as a subject as you can possibly find out there. So I appreciate y'all. Much love as always, and have a great day. Don't forget to smash.